Currently work for Collins Community Credit Union, serving all of Eastern Iowa.
Why don't you let everybody know just a little bit about where those rates currently are right now, and from a mortgage lender's point of view, your opinion of those?
It's interesting. Everyone calls me about the Fed funds rate going up, and as that's gone up over the last couple months, our interest rates have actually gone down. So we're actually sitting at the lowest levels in the last year or so when it comes to interest rates. So I just want to let everybody know that Fed fund rate is more towards that short-term borrowing, home equity lines of credits, credit cards, auto loans is how that impacts it, where interest rates are typically on a longer scale and they don't correlate. They're not matching up exactly on that piece. So rates have come down and they're at a very good level and still very, very historically low. I was going to say, I don't mind it when the Fed does that because it gets people thinking about interest rates and thinking about what I need to be doing. And I just got a graph actually today from Keeping Current Matters, and it shows what interest rates were historically. And I'd like just to share that with everyone because everyone thinks now that we're in the fours, rates are terrible and they're awful. But let's look back a little bit in history. And I'm looking at a sheet here that I just got. In 1970, the average interest rate was 8.86. In the 80s, it was 12.7. The 90s, it was 8.1. Wow. And in the 2000, it was 6.29. And these are numbers from Freddie Mac that were just published here recently. So our 4.25-ish interest rate on a 30-year fixed rate loan is absolutely awesome if you look at it historically. Because I think what people are concerned about is like the affordability of a mortgage and interest rates. Keep hearing in the Wall Street Journal or all that kind of stuff that interest rates are going up. A lot of times when you see it in the news, the move's already happened. They're already saying that rates are going up, and then now all of a sudden realize that rates have settled back down. So make sure you're talking to a local professional about what your timing is and what those interest rates are. And don't take that national news because obviously real estate's very local and interest rates are driven differently in different markets around the country. So talking to the local professionals are definitely what you need to do. I've had clients come in and say, hey, I need to get going on this buying process because I've heard rates are going up. And then when we dive into it, obviously rates have settled back here in the last couple months. So they're like, okay, this is awesome. Now I can buy a little bit more house than what I was thinking because rates were going, or I can save money because of that. So the conversation is always around interest rates anytime you're talking about mortgages or refinancing or building and how to protect yourself and how to get the best rates. So it's always part of the conversation. The news just drives it a little bit with the Fed fund changing and then obviously a lot of the articles that you've seen over the last few months about rates increasing for sure.
Any kind of idea or inkling whether they're going to kind of continue? And I know you don't have a crystal ball, but everybody always asks me, Jerad, are they going to continue to drop in these next few days, in these few weeks? Should we do something soon, or are they then going to go right back up? Any inclination on what's happening there? Everything's so now. So if interest rates are climbing, it's a big issue now. But if you look at the swing and where things have been, it will put a little bit of perspective. But I think the key that I'm picking up on, Tim, is for you individually. Is that accurate?
Yes. One of the things I tell every client is start earlier in the process than what you think you need to. I got a perfect story this week. A client came in. They had one collection on their credit report, a recent one. It dropped his credit score roughly 60 points.
Wow.
With that change, one change, everything else was perfect on his credit report. One collection added 0.25% to his interest rates. Wow. So while that doesn't seem like a huge number, but you take 0.25% on a $300,000 mortgage over the next 30 years, that's a significant deal. So if he would have started 90 days ago, we potentially would have been able to get that cleaned up, have that season a little bit more, and have that interest rate just slightly lower because of that better credit score. So I would say number one is start early in the process. Number two, have a face-to-face meeting with that loan officer and talk through everything about the mortgage. Ask about mortgage structures, different ways to put the mortgage together, but it's not the only thing. I think the consumers have been driven to, oh, what is your interest rate, instead of what is the total cost of borrowing money over the time that I'm going to have this mortgage. And that can be a much better question to ask your lender is, how much is this going to cost me for the 5 years that I'm going to be in this house or the 10 years that I think that I'm going to be here, and calculate that in, because there's different structures and different things that we can do as lenders to help you reduce that overall cost, and the interest rate's only one piece of that puzzle.